Okay, Todd Duitsman, my good friend. So Todd always loves to ask me these economic questions, and he goes, "Hey, what about this? What about that? Jobs, the stock market, the carry trade, rates, what's happening?" I said, "Brother, man, let's just get on. Let's do a live. Let's communicate this together and have this discussion, because I think a lot of people are asking the same question right now, Todd. So what's your first question, and then let's go through this together."
Well, Anton, to be honest with you, first of all, thank you so much for having me on. I appreciate that. You're
Yeah.
busy, got a lot of stuff going on. And it just first thing this morning, I come in, I'm talking to Luke a little bit, and he goes, "Man, yeah, did you see the stock market?" I said, "No, I hadn't looked at it yet today." And so then all of a sudden I looked at it, and then I looked at the rates dropping, and I'm thinking, I need to call Anton. What's going on here? Why are rates dropping, Anton?
I think the easiest thing to do is what I'm going to do is I'm going to share one of my screens. Present, share screen, and we're going to go to this tab right here, the 10-year Treasury. Okay, perfect. So if you want to know what's happening like in residential real estate or just real estate in general, you can always go and look at the 10-year Treasury. Okay? So the 10-year Treasury, whatever's happening there, that reflects the whole real estate market in regards to rates. So whatever direction the Treasury moves is the direction rates are going to move. So let's look at this, and let's make this a little bit smaller. Let's look at this over the last 3 months, okay? Even 6 months. So over the last 3 months, rates basically, there's always a spread, right?
Yeah.
So there's a spread there's a spread between the 10-year Treasury and 30-year fixed debt. That
Okay.
spread, Todd, is normally about 180 basis points or 1.8%.
Okay.
Right now, because debt's so expensive and banks want to make more margin because they know their loans are going to get refinanced, that spread is 260 basis points or 2.6%.
Okay.
So basically, if you come over here and you start looking at this and you just add 2.6, that's roughly what your debt was. So when debt was at 7, okay,
Okay.
and this is, you can see debt trending down right here when you look at the 10-year Treasury.
Okay.
Then we got that negative jobs report, boom, right here.
Yeah.
And the stock market dropped, and boom, the 10-year Treasury dropped. So the 10-year Treasury dropped on Friday to approximately, 3.8.
Okay.
And on Friday, mortgage debt, 30-year mortgage debt was approximately 6.4.
Okay.
So we know that this was already trending down from its peak. So last year, we hit, 7.5, right?
Yeah.
We started the year at about 6.75. This is us hitting 7.25 again. And then all of a sudden, boom, bad economic data, and it just plummets.
Yeah.
That right there, and it says it right here at the top of the screen, that's a 52-week low.
Okay.
So we're sitting at a 52-week low, but the question is like, well, what happened here?
Yeah.
Like, what caused this to happen? So one, we just talked about rates. We talked about the direction of rates, but why did it drop so fast so quickly?
Exactly.
Okay, let's go look at the jobs report. I gotta share
But
a different.
hasn't the jobs report been kind of padded this whole year?
Yeah. Yes. No. Maybe so. 99 banana. The
Yeah.
the reality is all economic data has to be put out by someone, and it's going to always be padded, and it's going to always have a number in it that people may or may not like. This jobs report, though, just look at these headlines. Market creators after Friday's job report.
Yep.
Tanking stocks. Market ends the day sharply lower. Poor jobs report sparks recession fears. So this job report, what it did was it said to people they expected the numbers to come in just a little bit lower. And if any of you have any questions while we're talking about this, just drop it into the chat, drop it into the comments, say hi. This missed expectations massively to the downside.
Okay.
So the jobs report was expected to come out, a little bit light, but it jumped. In other words, unemployment jumped. As it missed, though, this was just the start of a catalyst. So this was the one thing that then caused a bunch of other dominoes right in a row to fall right after that.
Okay.
So the jobs report comes out, and they say that, we have a lot more people watching us on TikTok. Thank you, people on TikTok. We appreciate you because there's more of you than anyone else, so we love you. The jobs report comes out, it misses to the downside, and that starts the catalyst. And the catalyst was simple. All of a sudden, recession fears start to spark here in the U.S.
Yep.
And there's one thing about like all this economic data, when this economic data comes out. As it comes out, whether it's correct or incorrect, it's all about Todd's perception of it.
Right.
It's all about Bill's perception of it. It's about, Susie's perception of it, the general public's perception. So as the economic data came out, it's fear of a recession that starts to make this even worse. So in other words, even if you are in a recession, but the general public believes everything is okay, then everything's okay. But as soon as bad economic news comes out, and then the general public, as sheep, as one herd, as one pack, all start to move together and go, man, we're in the middle of a recession right now, then it starts to get even worse.
Got it.
So those recession fears really spiked up. And Susan just asked, do you think this might have been warded off if the Fed had lowered rates at the last meeting? The answer is possibly, but we didn't want the Fed to lower rates at the last meeting because the Fed, generally speaking, telegraphs exactly what they're doing way far in advance. And they had not telegraphed or shown the general public that they were going to cut at that meeting. So for them to do it then would have been too soon. Now the market has started to price in, if you go look at the CME FedWatch tool, the market has started to price in exactly almost 100% chance of a rate cut in September. So Susan, right now I believe they are coming for a rate cut in September, and that will probably also end up with one in November and December. But don't expect the Fed to just magically pop up and bail us out because of these contagion fears that are started. And we'll get into that a little bit more. So if you have more questions, ask me. But my thought is, I don't think they should have lowered at the last meeting. I actually hope and wish they were going to wait until after the election because I don't want them to seem political. And I don't think they're going to come out and do an emergency rate cut. So Todd, going back to this real quick. The market then starts believing the recession might be here, and the stock market starts to sell. Okay. As that stock market starts to sell, what we see then is we see other factors then combining in on top of this. Okay, so what else, if you did any reading or have been following this, what else hit us? Or what else do you know about?
I just watched the stock market crash, watched the rates drop. And I'm thinking, are we being played? Is this manipulated? What is going on here? I'm a real estate agent that sells properties up and down I-5 in Snohomish, Kings, a little bit of Skagit County. And so how will this affect Todd? How will this affect other real estate agents?
Yep. Yeah, so Todd said stock market drops, rates are going down, and he wants to know how is it going to affect us here locally in the North Seattle Metro? Well, in the North Seattle Metro, where we live, with rates coming down, we know that's going to increase demand for on the buy side. However, we are still headed into an election. And so when you head into an election, there's just fear, because it
Yep.
doesn't matter if they're Republican, if they're Democrat, if they're independent. The election looming out there is just this massive uncertainty. And so with this big uncertainty sitting there, it causes the buyer just to slow down. So what I think people should be doing right now, one, if they're a buyer that, barely qualifies and they need closing costs, rate buy downs, things like that. We see that that 30-year fixed debt is trending down, and we know, and I believe, that the Fed is going to have to lower rates, so debt's going to get cheaper, right?
Okay.
So if debt gets cheaper and demand also keeps increasing, is it going to be easier or harder for the first-time home buyer to be able to purchase something?
It's going to be tough because all of a sudden, if the rates drop and we stay with the same amount of product on the market, or maybe even less as we move into the winter, it could become a bloodbath again, right in the middle of. I mean, the last two product that I put on the market, we're getting bidding wars on it.
Yep.
In the high fives and $600,000. It's kind of an interesting deal, and that was before the rates dropped.
Yeah. So even with expensive debt, you were still getting bidding wars because of low supply.
Yep.
So then, as it gets cheaper, you expect bidding wars to just increase.
I would. Yes, that's what I think is going to happen.
So that's what I 1000% confer with you. The only other outside factor, though, is this fear. So the fear is the carry trade from Japan, and the yen to the dollar is causing a contagion, and that's what's causing the stock market to drop. The fear is we have an unknown presidential election coming. The fear is the potential of World War III, popping off. And, Angel just brought, that up in the comments. Could the fear of war be causing this? Absolutely, Angel. So that's this goes back to that herd psychology. As the jobs report came out, then all of a sudden people go, it's a recession coming. And then they go, oh, there's potential for World War III coming. Oh, the carry trade in Japan. So that's all of these factors, because it's not just us living in a local economy, local market. Rates are the whole globe. So what happens in Japan affects us here in the U.S.
Got it. So Anton, being the biochemist, the amazing maniacal biochemist, switched into real estate agent that loves stats, love numbers.
Yeah.
What do you see happening now? We're moving through the middle of August. The election is coming in November, obviously. So people you would think would be tightening things up. Yet I'm still seeing, I just talked about multiple offer situation. As you move into the end of this year, are you purchasing? Are you holding back? Well, tell me what your thoughts are.
Well, good question. So I want to pause that for a second, and I want to finish our thought on the drop, right?
Okay.
So we'll come back in 2 seconds. But my thought on the drop is very simple. All of a sudden, the stock market in the U.S. starts going down, and this carry trade, which has been going on for a while, becomes unprofitable. So I want to share my screen so I can illustrate this.
What is carry trade?
And I'm going to try to make this like Peter Rabbit simple stupid.
Thank you. I am a realtor.
Well, it's not just that. It's this right here is good old-fashioned arbitrage. And this is like one of the most simple examples of arbitrage that's been happening for quite a long period of time. So, Todd, did we get a bunch of inflation here in the U.S.? Yes or yes?
Oh, yeah.
Well, Japan did not get a bunch of inflation. So while everyone else raised their interest rates, Japan kept their interest rates artificially low. And so what happened was, in Japan, you could go put money into the stock market like you can here. And then you could go borrow against your stock market account just like you can in the U.S. on margin. And there was an arbitrage that was created. So let's let's make this really simple for a second. What's an arbitrage? An arbitrage is real simple. I go borrow money from Todd at 4%. I turn around and loan it to Bill at 6%. I make a 2% arbitrage between that.
Okay.
Well, that's what traders have been doing on an absolutely huge, massive level between the Japanese market and the US market. Because you could still borrow super cheap in Japan and then come over to the US. So here's what they were doing, Todd. You could basically borrow at 0.5% to sometimes 1.5 or 2% on your account in Japan.
Okay.
So if you have $100,000, they'll give you 50 grand. So you take your 50 grand and you turn around and you go buy US treasuries. And those treasuries are performing at 4%, 3.5%, or you put it in a money market account and make 4%.
Mm-hmm.
Or if you're super crazy and you love leverage, you go buy Tesla or Nvidia or some part of our stock market on leverage. So you take your 50 grand and you go buy 100 grand worth of stock because they'll always let you leverage. So what you're seeing here is a massive deleveraging cycle, all started because our stock market started to drop. And what happens is when these big trades are spread out across, in this case, multiple regions, multiple countries, multiple, probably the whole continent, margin starts getting called. And everyone has to unwind because they're getting obliterated. So what actually happened? Let's share the screen. So Japan says, oh my goodness, we got inflation. They have to start raising their interest rates, right? So they start raising their interest rates. And just like when we did here in the US, when they raised their interest rates, the value of their currency went up. Well, the problem is if I was borrowing at 1.5% and now it's 2.5%, but I took that from the yen and I put it into USD, not only am I getting hit now on less of an arbitrage, but the value I exchanged into went down 10, 15%. So you see how this starts to become a snowball?
Yeah.
So
what does this look like for Japan?
Oh, bro, it's a problem. This is a problem for Japan. So look, right here is July 7th. This is starting to unwind. The yen is 160 to $1. And then look at that. Boom, just drops. So that's like a 15% drop. So during this whole upcycle right here, it's okay to do this trade. I go borrow from my stock account. I create an arbitrage. I go put the money in the US.
Yep.
Now all of a sudden, my US dollar versus Japan just lost 15%. Uh-oh, there goes 15% of my investment.
Yeah.
But if I buy it on margin, now all of a sudden it gets even worse. Okay? So that's what's happening here. And Jennifer goes to me, she's like, how big of a problem is this? And I was like, this could be the contagion. Like, this could be ground zero for the unwinding of the global economy. And she's like, is that going to happen? I said, no, it's not going to happen. Because what happened was the Japanese stock market dropped over 12%.
Okay.
And they have these circuit breakers, for lack of a better word. Gets too crazy, circuit pops, shuts it down. Japanese market shut down. So as that shut down, that drop, that also slowed us down over here, but it's also why we dropped a little more today. I'm not a full stock trader, so none of this is financial advice. I'm just giving you opinions right now. Seek legal counsel. Go get a freaking attorney. Go get a tax guy, blah, blah, blah. But you now ask yourself, is this a buy the dip opportunity in the stock market? How much more of this has to go on for these positions to unwind? And then is this just a moment in time? Because I think it's a little bit of a moment in time Because guess who the largest holder of debt is of U.S. Treasuries? What country would maybe possibly own the most U.S. Treasuries out of any country in the whole wide world?
China?
Japan.
Oh,
So Japan currently, and let's look it up. Biggest holder of U.S. Treasury bonds. Okay, let's go back to this share screen. Okay. AI is telling me as of May 2024, 1.13 trillion held by Japan.
wow.
Okay, so this is stuff you can go look up. China's number 2, so you're totally right. But if this is the largest holder and their own treasuries are now rising in yield, and they have something that they bought that was performing at 4.5%, when they bought it, and now
Yep.
the yield is going down on that, Japan may be forced to start selling and liquidating all of their U.S. holdings to prop up their own.
Oh, interesting.
So this is like the contagion that people are worried about, right? This is the item where they go, oh my goodness, this might be a problem. Now, having said that, I actually don't think this is going to take out the U.S. or take out Japan. I do think, though, that this is the start of things breaking in the background. You know how the Fed, we know we'll get there when we get to a certain inflation and a certain unemployment rate?
Yep.
Well, the other thing that they have to do is they have to protect the economy. So if things like this start breaking, they have to protect. So one of the other text messages I got earlier today, Todd, was, well, do you think this means they're going to come and do an emergency rate cut because this is so bad? No. The Fed is not coming to save you. That's not in their dual mandate. 2, if they can cause inflation to go down and unemployment to rise a little bit more, that allows us to go through another boom and bust cycle. So they are going to allow us to definitely experience more pain through this. What does it mean on the real estate side? On the real estate side, for you and I, for local people here throughout the Seattle metro, and to be honest, most of the U.S., real estate's already in a recession. We've been in a recession.
Yep.
But we've been in a transaction-based recession.
Okay.
And because of the great financial crisis, everyone just immediately assumed, oh, rates are going to go up, and so prices are going to crash like they did in 2008.
Yep.
But that was a supply and demand fallacy. See, we had an oversupply and a high amount of foreclosures then. Right now we have an undersupply and historically low foreclosures.
And historically low interest rates. For the people that own that have a mortgage on their property.
Oh yes, no, wonderfully said. And historically low interest rates for isn't it 80% of all mortgages right now are below 4%?
Yeah, it's some outrageous number. Yeah,
it's some outrageous number. So when you look at that, what that means is they don't have the incentive to sell.
Correct.
Therefore, even if we are going into a recession, for us in real estate, it actually means nothing because you've already been in a transaction recession.
Yeah.
Therefore, prices should continue to rise even as rates fall, even as the economy slows down.
Yep.
And like Angel said, Angel, I agree with you. You get that comment put up. It's just more opportunity, buddy.
Yep.
So I want to circle back around. You said, what should we be doing? What am I doing? What I'm doing right now, and I can't recommend everyone do this, but what I'm doing right now is I'm selling some of my out-of-state assets to bring it back to Seattle because I believe we're going to have more appreciation here than we will for those out-of-state properties. 2, I'm selling some of my in-state rentals in order to be able to go buy more land and go do more dadu projects.
Got it.
3, I'm working with some of our investors right now to go buy good projects today with partners to get them built in the future.
Got it.
Next one, I'm starting as many development projects as I can right now because we're at this weird moment where things are being pinched. So as they're massively being pinched, I'm starting to get slightly better deals on construction, on excavation, on some of the material.
Mm-hmm.
And some people's schedules are going up. So what I recommend to any investor or any hardcore buyer is you need to go make a bunch of offers right now. You need to like capitalize on this opportunity because there's still fear and uncertainty. But
Yep.
from a real estate perspective, the underlying fundamentals of the economy still look very strong in relation to real estate, even if we are going to go through some bumps.
Yep.
Don't expect the Fed to ride in on a white horse emergency rate cut and save us. I think they're going to go low and slow like they've always done. They always overdo it because they can cut faster than they can increase in order to change the economy.
Got it.
What else are your questions, bro?
That was the most, that was on my mind this morning as I woke up and started reading through the news and trying to understand what was going on in the market, and then how obviously it affects us up and down I-5. And also, just to touch on your dadu, I was just down at
Yeah.
the city of Everett. Super interesting. They've had 79 permits. You would have expected it to be hundreds and hundreds of permits.
Yeah.
I think 45 are active, or 45 have been actually signed off as being built.
So they have
in that whole
79
city.
submitted and
Yeah.
49 started.
Yeah, 49 started. Yeah.
In a city with 110,000, 120,000 people?
Yeah. Not fascinating.
That's the proverbial drop in the bucket of
Yeah.
just barely anything.
Yeah, and just learning that pattern, and you know, it seems to me, it seems like such a great opportunity to get ready for next spring.
Yes. And I think that's, yeah, so according to Google right now, 110,629 live in Everett, Washington.
Yeah.
And they did pass their dadu or mother-in-law, cottage ordinance to be able to put 2 of those in the back. And like Todd was just saying, there's only 79 in the hopper out of a major city. So
Yeah.
that right there is what Angel was referring to. There's massive opportunity there.
Yeah, for sure. So, yep, those are my biggest questions, just to see how that affects us.
I love it. Thank you for your questions, Todd, and always for being my good friend and helping me find deals. Todd, how can people get a hold of you? How do they find you?
Best way is to give me a call or a text at 425-343-5040.
I love it. Hey, thank you guys for coming on, hanging out with us, and let me know if you need anything else.
Thanks a bunch, Anton.
Take care, bro.
All right, bye.